Hello, everyone, and welcome to today's webinar on coordinating and managing and maintaining of life insurance without various trusts. Such an interesting topic, and it has been presented by the one and only Henry Montage, who is a CFP as well as the managing partner of the Tolley Centeris that helps people better understand their life insurance portfolio, regardless of whether a person owns their life insurance policy individually or through a trust. So this is going to be a really engaging webinar where you'll get to know the nuances of the topics. Henry Montage is better to explain about this. And while I'm waiting for everybody to join in, I would also want you to let me know in chat, where are you from? How's the summer treating you? I hear that Lake Tahoe has got an influx of people coming in. So let me know where you're from and how's the weather there. And in this webinar, we are going to be having polling questions that are going to be coming up at random intervals. So make sure you're attentive throughout the webinar and you submit your responses to the polling questions. Towards the end of the webinar, once some time is left, Henry will be answering all the questions that you can submit throughout the webinar through the Q&A panel as well. My name is Saul, but I also have my colleague Jim Ray with me, who is the co-moderator, and he'll also be there throughout the webinar. If you have any issues or you face any technical concerns, feel free to reach out to us through chat in this webinar or through our chat on our website as well, or you can email us at support@my-cp.com. If you're facing any issues in the webinar, we'll be glad to assist you with that. So without further ado, welcome, Henry. It's been a pleasure to have you on our platform, and you can take it away.
Thank you very much, Saul. So with all this talk about chat, I'm just wondering how soon before ChatGPT replaces people like me?
Well,
I don't think so. I don't think so.
I don't think so because the thing is, AI is there to assist us human beings. That's something that we always got to remember. It may be there to make our lives better, to give us more freedom in our lives, but it will never replace the human element. There's this, like, the trolley experiment. If AI was asked to choose, they may not be able to choose. So, AI cannot get a sense of that.
A lot to be said about judgment. And talking about judgment, I just like to thank you, Saul, and thank your organization for putting this together, as well as for your personal programs in terms of feeding the world population. So thank you for that. So my job over at the Tolley Center is to basically reintroduce a person to their own life insurance portfolio. Something nobody wants to do. My purpose today is to be able to talk to you about the importance of life insurance and how and why it must be maintained, not just individually, but also, as importantly, if it's held in a trust. And we'll talk about the different types of trusts, or if it's held in an agreement, such as a buy-sell agreement. So with that thought in mind, let's move on to the agenda. Trust-owned life insurance is a very good financial instrument. We're going to talk about its purpose. We're going to talk about the funding of a ILIT, an irrevocable life insurance trust, and we'll talk more about that in a little bit. We're going to talk about the 6 most popular types of life insurance policies briefly, but I just want you to understand really just the best uses for each one and what they are. We're going to talk about some of the problems that consumers are facing with non-guaranteed universal life insurance. We're going to talk about preventing the problems from occurring. And we're going to talk about what the trustee's role is in what they can do to prevent the problem and avoiding fiduciary liability. Many of these trustees, not many, all trustees have fiduciary liability. Unfortunately, they're not all aware of it until a lawsuit might come about. So we'll be talking about that as well. We'll be talking about fixing the problem. We'll be talking about various options to be able to pay future estate tax obligations using both an ILIT, an irrevocable life insurance trust, with the funding mechanism, a life insurance policy, one that's hopefully guaranteed to outlast the individual that it's insuring. And on that point, we'll talk about something called second to die life insurance, which is a specific product that can be used specifically to pay for estate taxes, because just as estate taxes are due at the death of the second individual, second to die life insurance, smart for the insurance company, first pays out at the death of the second individual. And for that, there's a less expensive cost. Some people take advantage of that. Those people that are aware of that do take advantage. Those that don't, unfortunately, can't. Much of this information that I'll be talking about today comes from a book that I was honored to co-author several years ago. I call it The Advisor's Guide to Managing Risk, the Advisors and Trustees Guide to Managing Risk. The Bar Association, the American Bar Association, they wanted to call it the Life Insurance Policy Crisis. Usually it'd be the other way around. Usually the author would want to have the loud, bold title, and the ABA would want to have the more conservative approach. This time was just the opposite. So let's talk about the different types of trusts. First one I'm going to talk about is the ILIT, the Irrevocable Life Insurance Trust. And an ILIT is basically used, as I said a moment ago, to pay for estate taxes, because it can remove the ownership of the life insurance from the individual and from the family to a third party. And that third party is the trustee. We'll talk about revocable trusts, those that aren't at all used for reducing estate taxes, but they are used for management and making sure that if well, with all due respect to 18-year-olds, if any individual who's named as a beneficiary decides to use his or her inheritance and buy that red Corvette syndrome, or basically spend the money foolishly, the revocable trust provides that management. It also is used very often for special needs trust when parents have a special needs child and they want to make certain that that child is taken care of after the parents are no longer here. It's certainly used in buy-sell agreements, individuals that have a business, and they want to make sure that if something were to happen to either one of the partners, that the remaining partner, the surviving partner, is able to pay out the family of the deceased partner. Just imagine, two people have a business worth $500,000. One person passes away. The deceased partner's family comes back to the surviving partner and says, business was worth $500,000. Can I have my check for $250,000? Not many businesses, as you accountants know, have $250,000 sitting around in some sort of retained earnings. So that in itself becomes a problem. Who does the remaining partner sell to? All these questions are addressed in a buy-sell agreement. And to make that buy-sell agreement really work, it's usually funded with a life insurance policy. Although many of your clients don't have buy-sell agreements, and they certainly don't have them funded with life insurance. Lastly, we'll be talking about a deferred compensation or a supplemental executive retirement program or a supplemental owned retirement program. People there use life insurance for its tax-deferred accumulation. Think about that. Life insurance has the ability to take a $5,000, $10,000, $25,000 contribution, let it grow, be it in mutual funds or be it in a fixed instrument, and have those gains grow tax deferred. More to be said on deferred compensation agreements later. Life insurance, as I say, is life insurance trusts, rather, are a tax-free leveraged risk transfer mechanism. It's a sophisticated financial asset. It also provides credit protection and, as I said, management, and it's ideally suited for trust ownership. But life insurance policies are not self-managing, and inadequately funded life policies can and do lapse, and we'll talk about that in just a moment. When I came into this business back in the early 80s, basically life was kind of simple back then. There was whole life insurance and there was term insurance, and that was it. It was like a Carvel store with chocolate and vanilla. Today, it's like a Baskin and Robbins with 18 different varieties. You've got policies for death benefits. You've got policies for living benefits. You've got policies that are guaranteed. You've got policies that aren't guaranteed. You've got policies that accumulate. As I say, it's a whole host of different policies. There's no such thing as a bad policy, only misused and mismanaged policies. When I came into the business, there were only two types of life insurance. It was whole life insurance and term insurance. It was like a Carvel. It was chocolate and vanilla. Today, It's like Baskin and Robbins with 18 different flavors, or today it's 18 different types of varieties. There's life insurance for death benefit. There's life insurance for living benefits. You've got policies that are guaranteed, that aren't guaranteed. You've got policies that are used for accumulation purposes. There's no such thing as a bad policy. It's only misused and mismanaged policies. So what's the purpose of an ILIT? A grantor names either his eldest son or daughter or a professional trustee and creates that individual that's known as the trustee. And that vehicle is then used to purchase and to hold life insurance proceeds and distribute it when they're needed. In the meanwhile, it provides management of assets and income, assets while the trust is growing, income when it's distributed. It provides asset protection in the event of a lawsuit. Can't sue a trust as easily as you can an individual. A trust actually is not really very prone to risks as far as an individual driving a car. Last I've seen, trusts are sedentary and they can't really get into trouble. The trustee has the discretion to invade the income of the principal for the benefit of the beneficiaries. And at the grantor's death, the policy proceeds are collected and distributed to the beneficiaries according to the grantor's wishes. And if set up properly, which it should be, the death benefit is received income and estate tax free. Grantor contributes money to the ILIT to be placed in one of 6 types of life insurance policies. The trustee distributes the crummy letter to each beneficiary, informing them that a contribution was made. Each beneficiary has 45 days to do whatever he or she wants to with that money to withdraw it. And again, not a very smart idea for a beneficiary to withdraw that money because the grantor would basically stop funding the trust. The purpose of that trust is to be able to provide a long-term benefit to the beneficiaries. But filing the crummy letters, it creates a gift of present interest and provides favorable tax treatment. And it also avoids the 3-year rule in contemplation of death. If you transfer a life insurance policy from one trust to another, it takes 3 years before that trust will actually be out of the grantor's taxable estate. So there's no substitute for doing it the right way the first time. What are some of the things to consider about life insurance? Well, okay, so term is the most popular type of coverage, but as we'll find out, it has some drawbacks. It's important to match an objective with the correct product. If you recall, just a moment ago, I showed you all different types of products, some that were used for lifetime benefit, some are used for death benefit, some are used for living benefit, some are used for accumulation planning. It's important to be able to match the person's objective with the correct product. There are various misconceptions about pricing. People think that when they hit 60, 65, life insurance becomes too expensive. Don't let that get in the way. Basically, even if an individual is sick and they think that they're uninsurable and that the cost is too high, those are, as I say, misconceptions, because an awful lot of the time, there are different insurance companies that specialize in different areas. So if an individual has had a heart attack or 2, he or she may think that they're uninsurable, but in fact, there very well is an insurance company for that individual. Same with a type of a cancer. Some people think that, oh my God, I had cancer, I'm uninsurable. Well, yeah, it's possible that with an active case, it's probable that with an active case of cancer, you're not going to get insurance, but there are many other levels of any risk that an insurance company is willing to assess. And the costs might not be that expensive. It's important for an individual to be, to at least be knowledgeable and to find out what the costs actually are. There are misconceptions about the assumed returns on insurance. What happens if, how long will my life insurance last? People are beginning to wake up and realize that not all life insurance will last for the rest of a person's life. What if I can't afford the premium? Do I just give the life insurance back to the insurance company? Is that the only option? Well, there are other settlement options and there are other exit strategies that the person should be familiar with. And I'll tell you, they're relying on people like you, their accountants, to bring this information to them. which additional riders, should I consider adding? And there are many riders. What's the best type of policy for me? The only way to find this information out is unless you yourselves are knowledgeable in the area, have a relationship with an individual who can act as a trusted resource and provide you with information, because no one is an expert in all different areas, and we've all got to rely on various expertises that we each have to be able to do the best job for a client. Whether a policy is owned by a trust or owned personally, the mechanics are the same, and we'll talk about that in a moment. So there's 6 types of policies. Term insurance is the one that's most popular, most common. It's only used to maximize the death benefit, and it's used so popularly because it has the lowest cost. There's a reason it has the lowest cost. But before I get to that, you can guarantee a term life insurance policy for 1 year, 5 years, 10 years, all the way up to 40 years. But here's the catch. It ends mostly at age 80, with some companies at age 82. Fortunately, today, people living longer, whether it's due to modern pharmacology or what have you, but people are usually living beyond age 82. And that's why term life insurance is so inexpensive. Only 2% of term life insurance ever has a payout. And that's because it ends at age 82. What's guaranteed in a term policy? The death benefit is guaranteed, the premium is guaranteed, and the duration of coverage, whether it's 1 year, 10 year, 20 or 30 or even 40 years, it's guaranteed. There are individual policies and there are group policies. Individual policies have various benefits, and you've got to consider both. You can't just look at the fact that group association term is less expensive, because group association term might be less expensive today, but it increases every 5 years. So if your intent is to keep policy into your 60s or 70s, that group association may become significantly more expensive to the point where you may not be able to afford the premiums. Whereas a private or an individual term policy, you can lock in the premiums for the next 30, 40 years, guaranteeing that you'll know what the premiums are, and that you probably will not let that policy lapse as you would with a group association term. As I say, term coverage, only 2% of the death benefit is ever paid. What are some of the incorrect uses for term insurance? Using it for a special needs trust. Imagine parents wanting to provide for their child when they're gone, and then the policy predeceases them. In other words, the policy expires before they do, and then the coverage for that child is no longer available. Or if an individual wants to leave a legacy for their children, grandchildren, beneficiaries. Okay. Whole life policies force you to accumulate maximum cash value. It's 100% guaranteed, but it is not the least expensive way to provide maximum death benefit for an individual. But it is a good way to accumulate money within an insurance policy. Keep in mind, accumulating money tax deferred on an insurance policy is one way to accumulate money. They've always got to be compared based on what other options and vehicles might be available. The rates of return on an insurance policy are basically, on a whole life policy, are basically 3%. And then they provide additional income by way of dividends, but those dividends are not guaranteed and they do fluctuate. But 3% guaranteed, you know where you are, you know where you're going, you know when you're going to get there. And they do that by way of cash value. So I'd just like to explain for a moment what cash value is. Let's just say in year one, very simplistically, the premium is $10,000. The expenses to set up that policy is $6,000 for various reasons, various fees and costs, including commissions. What's left is $4,000. That $4,000 grows. Let's assume that it grows at 3%. There's your $120. At the end of the first year, the net cash value is $4,120. And that will continue on a compounding basis each and every year that the contract is in existence. $10,000 premium, if that were a term premium, the cost might be closer to maybe $600-700 for that same individual with term insurance rather than with a whole life policy. But it is a good vehicle for a conservative investor to be able to provide tax-deferred growth accumulation. Okay, in an index policy, I'm just going to say that an index policy works based on a return of a mutual fund or return of an ETF. If the return is 10%, a index policy will give you 75% of the gains. But if you have losses, they will eat those losses. So an individual with an index policy, if the gain is $10,000, they'll get $7,500 of that. But the following year, if the loss is $5,000, they will not lose any of that. It's just a index, and it's predetermined, and it's an available product. A variable product, rather than working on ETFs or mutual funds, basically works on just stock market returns. Yeah, there can be some indexes in there, but the returns are based on an assumed rate of return. And just imagine if you assume when the stock market is good that the average return should be 10%. You assume that because for the last 15 years, the S&P averaged out to a 8-9% return. Keep in mind, I said assumed, but the death benefit, which relies on that cash value, is not guaranteed. So in this situation, the client in a variable life insurance policy, VUL, the client assumes 100% of the market risk. 100% of the market risk. I'm going to skip the talk on the PPLI, the private placement life insurance, for the time being. What are some of the problems with a variable policy? Well, I just mentioned a couple of seconds ago that a individual can take a look at a chart showing the last 20 years of S&P returns being in the 8 to 10% range. But what happens if an individual bought a universal policy in 2020, and then in 2022, the S&P declined by 29% as it did last year? Well, in this year and in future years, a significantly higher premium should be paid to make up for the loss in 2022. But that's typically not done. And that's usually what creates problems long down the road for the individual who owns a non-guaranteed life insurance policy, such as a variable universal life policy. What will happen is the shortfall compounds and eventually becomes unmanageable. Eventually, when there's 12 months left in the coverage, the trustee will receive a notice, letter stating that the policy coverage will expire within 12 months unless a significantly higher premium is paid. And that usually results in the duration of coverage expiring prematurely for one of two reasons. Either the trustee or the insured can't afford to pay the higher premium, or chooses, screw you, insurance company, I'm not paying the high premium. Either way, the insured is out the insurance, and the life insurance company keeps the premiums that were paid, but never has to pay out a death benefit. Okay, so here's the problem. Non-guaranteed universal life insurance, which, by the way, makes up about 55% of existing life insurance today, is of a non-guaranteed nature. I'm speaking of everything other than term insurance and other than whole life. Interest rates have decreased over the last 20 years, but the individual who bought a policy 20, 25 plus years ago, when interest rates were upwards of 9-10%, has seen interest rates decline. I'm forgetting the last 6 months, has seen interest rates decline over the last 20 years. But yet the premium that he or she receives from the insurance company is the same premium that was paid 15 or 20 years ago when interest rates were much higher. The death benefit remains the same. But the only thing that's shortened is the duration of coverage. That's the only variable. And people aren't aware of that. People should have increased the premiums as interest rates decreased from the 10 or 12% down to the 7 or 8%, down to the 5 and 4%, down to where they are today. Forgetting today, this is a current anomaly right now, but I'm speaking of over the last 25 years, interest rates have been on a steady decline. But people's philosophy was life insurance is a buy and hold asset. I buy it, I put it in the bottom left-hand drawer, and I forget about it, as opposed to what it should have been, a buy and manage asset. So that each and every year or every few years, as interest rates declined, the owner or the trustee should have said, gee, this was based on when interest rates were 10, 11%. Today, my policy just yielded a return of 7%. I should probably increase the premium. And that should have happened throughout the last 20 years. Every 2-3 years, a non-guaranteed policy must be reviewed, not should be, must be reviewed. Otherwise, you're going to wind up with the reason why the American Bar Association had me write a book called The Life Insurance Policy Crisis, because policies are expiring prematurely, and they're increasingly doing so. As I say, as a result of years of reduced interest rates and neglect, 40% of coverage today is increasingly expiring prematurely. All right, I don't want to beat a dead horse, but policy was purchased in the 90s. As I said a moment ago, it was purchased when it was 12%. Now it's decreased, and I just basically went over this information, so I'm going to just slide over this. Okay, am I the only one saying that life insurance policies are not being managed and are expiring prematurely? This was the Wall Street Journal. This was the senior editor who happened to have written this paragraph as an endorsement for the Advisor's Guide to Managing Risk. I'm just going to be quiet for a moment, just to ask you to take a half minute just to read this. Right, that's the Wall Street Journal saying that. This is the general counsel for the Insurance Marketing Association. And what he has to say is, while insurers have not publicized the issue, there is a growing concern of the industry about lapsing universal life policies. There should be, but there's not. There should be much more of a concern. This is the typical page 5 from a 7-page annual report. Down at the bottom, for those of you that can't see it, it says important notice. Important notice. If this was an important notice, it should have been plastered on the top of page 1 in bold letters highlighted in red. Let's see, it says, change in interest rates may impact the insurance coverage and cash value objective of your policy. You may need to adjust your payment amount and or death benefit to maintain your original objectives. That's the insurance industry. Keep in mind, the insurance industry is not obligated to protect the consumer. The insurance industry is obligated to make a profit for the shareholders or the stockholders of the insurance company. So Saul, if you're there for the first polling question, why are non-guaranteed policies expiring early? And you've got 4 choices. Saul, are you going to end the poll or should I?
Henry, I will end the poll once we have received the
Sure.
answers
Okay,
of
I just want to know procedurally. Okay, thanks.
Yep. All right, everyone, last 5 seconds to go. And there we go. Thank you, Henry. You may continue the session.
Okay, well, let me just get rid of that. Okay, so again, the correct answer is all of the above. All of the above. Insurers benefit. It's certainly part of the neglect on the part of the owners, the trustees, because they didn't know they had to increase the premiums along the way, and the fact that interest rates have been steadily declining over the last 2 decades all contribute. And for some reason, I'm not able to forward my slide. I don't know if anything occurred on your end, Saul, but I'm not able to forward my slide. It's frozen. Jim, can you help me out?
Yes, Henry, in that case, you can simply stop sharing the screen, and then, you can, restart your presentation and then share the screen again.
All right, so I'm going to stop share.
Mm-hmm.
And now I'm going to share the screen again.
In that case, I would request you to, restart your PowerPoint once again.
Okay.
It might be the case that the reason for getting it stuck. So,
All right, let me just see. Let me just try to get us up to the same slide that I was in before, and then I'll proceed.
I think you were on slide 22 for the first polling question.
Can you just give me a second?
Sure. No, that's not.
All right. I'm not able to get to share to the slide presentation because the black bar is in front of it. Let me see if I could just move that down. There we go.
Sure.
Okay. Now let me. Okay.
Mm,
This should work. Okay. So my observations are, sorry about that. So my observations are that the insurance company could have done a better job of communicating to the general public. The agents should have been directed to service their clientele better. But as I say, insurers benefit when policies expire. And most people take responsibility to do a terrible job of managing their own life insurance policies. Okay, so what's the solution to the non-guaranteed universal? Obviously, a guaranteed universal life policy, which has all of the benefits of a universal policy, which is maximum death benefit, lowest cost, because you're not using the insurance for the accumulation, you're using it to provide a maximum death benefit for a specific period of time. Today, you can guarantee a specific amount of coverage to last until age 90, 92, 93, 95, 100, 120. And the quoted premium that you'll get will be guaranteed to maintain that coverage for that time period. Therefore, you are having a guaranteed universal policy. So, trust-owned life insurance, whether it's trust-owned or privately owned, how long it remains in force basically depends on the advisor's role, the insurance agent's role, the CPA's role, the private trustee's role, the institutional role, as the mechanics of both policies are similar. So let's take a look at that. The attorney's role, as well as the CPA's role, they make sure that the I's are dotted and the T's are crossed, that the beneficiaries are named, that the crummy provisions are put into place, that the ownership is put into place, and the accountant hopefully makes certain that there's adequate cash flow to be able to pay for the policy this year. They may not look 5 years down the road, or 10 or 15 or 20, or in some cases, 30 or 40 years down the road. So there's some holes in the gap. The private trustee's role, now keep in mind, this is usually your client's oldest son or daughter. And if your client knows very little about ownership or management, fiduciary liability, responsibility of a life insurance policy as a trustee, you got to imagine that their kids know even less. Okay, so they don't have the skills and they don't know what they don't know. And worse, they often assume that everything is taken care of by the insured / their mom or dad's accountant or attorney. Haha, it's not. The agent or the broker's role, and point of information here, the agent is usually an individual who works for an insurance company on an exclusive basis, whereas the broker's role is to be able to be independent of a company and pay their own expenses. And the broker is able to go to any insurance company that they choose to. But whether it's the agent or the broker, they don't go back to the client to say, by the way, that $5,000 premium that I suggested that you pay 5 years ago should be increased to $6,000 today because interest rates have come down. They don't go back. They don't do that. They don't do that often enough. As a practitioner of 35 years, I can tell you the remainder of what I see of policies not managed. Why? Maybe because the lion's share of commissions are earned up front and there's no financial incentive for the agent or the broker to go back. They're embarrassed to ask for a larger premium. Aside from that, 89% of agents in the first 3 years leave the business, and then they're handled by I'll call it a phantom individual, somebody who's, obligated, who's been asked to take the obligation for contacting and the responsibility for clients that they don't know. And oftentimes that doesn't work out too well. And that aside, the clients don't trust or really don't understand the policy. And the agents aren't really explaining it the right way to them. So whose fault is it that my coverage ended? Can I blame the insurance company? The insurance company should have contacted me. Should I blame my broker? He's or she sold me the policy. How about my attorney? He drafted it and had me do something about some letters, crummy letters that I had to sign, or maybe that was my CPA that did that. But no one told me that my policy needed management. It's none of their legal responsibilities. It's 100% the owner of the trustee or the individual owner of that policy, whether it's owned individually or whether it's owned through a trust where the trustee is the individual. On the other hand, there's the institutional trustee. But keep in mind, 90% of policies are managed by what I call an accommodation trustee or an uninformed trustee. Your client's eldest sons or daughters. The institutional trustee, on the other hand, knows what to do, and they want to minimize their own liability. So they want to avoid any damage to their reputation. So they're familiar with all the relevant responsibilities. And if they're not familiar, they know that they have the obligation to go out and contract for that information from those that are. 90% of the trustees are the informal or the amateur or the accommodation trustees, your client's eldest sons and daughters. Only 10% use an institutional trustee. Why? Perhaps because the institutional trustee charges for their fees and services, whereas your son or daughter usually don't. But keep in mind, clients basically get what they pay for. The benefit of the life insurance audit, basically, it just provides trustees an independent objective evaluation of their life insurance policies. It gives them a stress test. They're able to prevent premature lapse. They're able to compare policy costs against features from other policies. They can prevent unwanted family disputes and avoid any client lawsuits. They can update the owner about the need to update their beneficiary and ownership designations on all policies. It's basically, the difference between what you have and what you want, what you think you have and what you want. Some of the most important things to reacquaint with your life insurance policy about, whether it's in a trust or owned individually, is the death benefit that you've currently got sufficient to cover that buy-sell agreement? Is it sufficient to pay for the estate taxes that you're going to be obligated to pay? What type of coverage do you have? Is it guaranteed? How long do you want your coverage to last? How long will it last? And how do you know? What are you relying on? What information are you relying on? Even if you believe that you know the answer, how are you getting that information? Is it valid? Is it accurate? People know what their coverage costs today, but most often they have no clue what it's going to cost 5 or 10 or 15 plus years down the road. And unless you know what your obligations are, you're more than likely to not meet those obligations if it comes out as a complete surprise. Find out. And the word reviewed is highlighted 3 times. When was it last reviewed? When were the beneficiary designations last reviewed and updated? When was the last time you reviewed and updated your trust or the premiums that you're paying? So let's come to polling question number 2. What's the prime benefit of an audit? And Jim, if you want to pick that up. Saul, if you can pick up the polling question number 2. Thank you. And whenever you're ready, Saul.
All right, last 5 seconds to go. 4, 3, 2, 1. Thank you. Thank you, Nrit. Back to you now.
Wow, the same thing just happened. After the polling question, something occurred and I can't forward my slide. Is there anything you can do on your end? Saul, is there anything you might be able to do on your end? Okay, then I'm going to do what I did before. Is that a negative, Saul or Jim? All right. Bear with me for a moment. Okay, I'm back. Sorry about that. So to avoid and fix a problem with the policy, a client has to be able to obtain and evaluate an annual summary statement and a historic projection. It shows how much premium the individual has actually paid and what the current value is, and to determine if an adjustment is required. Or if he or she doesn't want to or can't do that, or for whatever reason doesn't have the ability to do that on their own, then they've got to engage an independent experienced broker to do the evaluation. Just like a company's got to pay someone to do a stress test, or a bank has to pay someone to do a stress test, so too does an individual owner or a trustee have to be able to evaluate the information to be able to eventually fix the problem. And there are 4 options that an individual has to be able to fix a problem. They can either reduce the face amount of the coverage, they can either pay a higher premium, or they can obtain a guaranteed new contract if they're qualified to do so. Or they could sell the policy as a life settlement, which is really an alternative exit strategy, or a combination of the 5 items of the 4 items that I just mentioned. Look, the trustee's responsibility is, as far as I'm concerned, has one responsibility: to make sure that the coverage doesn't expire before the individual client. So today, a buy and hold strategy is not warranted. A trustee's got to be proactive, and they've got to determine if a policy is underperforming, and that I call buy and manage as opposed to buy and hold. And there are certain things that an individual has to do. They're listed below. Let me go into one or two of them. It's based on the UPIA, the Uniform Prudent Investor Act. Bottom line is, you've got to treat a life insurance policy just like every and any other asset. You wouldn't have a bond, stock or bond portfolio sitting there in your bottom left-hand desk drawer for the last 4, 5, 10, or 20 years without looking at it. It's subject to an ongoing review, so you've got to treat life insurance just like any other asset. An investment policy statement. What do you want to have happen with that accumulated funds? What's the purpose of the policy? Needs change, beneficiaries change, risk management changes, a client's guidance is necessary, and that can be input and communicated to the trustee through what I call in my practice an investment policy statement, which every 2 years is looked at and updated. For the accountant, the adequate funding statement is necessary. It defines the required premium, not just to guarantee the policy this year or next year, but to let the client know what that adjusted policy may be 5 or 10 years down the road. What's it based on? Is it based on a variable product where there are no guarantees? Or is it based on a guaranteed product where the risk is known and the outcome is known? But it provides documentation for the trustee, and it shows in a lawsuit that he or she did what he or she needed to do. So the overall summary is there are many responsibilities to consider when acting as a trustee. The trustee is not just a mere custodian, but she's also a fiduciary with legal responsibilities that in most cases the trustee is absolutely unfamiliar with. And by the way, one of the quickest growing areas of litigation today is estate litigation, where siblings just sue each other. Because what do you mean that $1 million or $5 million policy that mom and dad had and told us about? What do you mean it's not any longer there because the policy expired? Weren't you the trustee? Weren't you managing that? How's this matter handled in your office? Okay, $2 million death benefit. Insured gets a letter, age 82, policy is going to lapse. The $29,000 premium that he's paid now is not sufficient. They're going to need $38,000 premium to keep that policy in force just to age 90, which is only another 8 years. And by the way, he's paid $500,000 in premium so far. Do we risk that $500,000 that the policy may lapse? Do we pay the additional $9,000 in annual premium? Can we afford that? You're going to be faced with these issues. The numbers may not be these numbers, but the problems are going to be the same, and your solutions are going to be looked for as far as guidance from. One way to handle that is you can take that annual premium and sell that policy as a life settlement to an institutional investor, and you can basically turn a bill into a liquid asset. In that case, the client chose not to pay the additional $9,000. And because his attorney referred him to me and I explained what a life settlement was, we were able to reduce that $800,000 non-guaranteed universal life policy into a $220,000 life settlement cash offer. So the client had no cash value in the policy. But yet when he sold and gave up the $800,000 death benefit, we were able to get him a $220,000 cash offer, which he gladly accepted. Another situation, a client age 84 had a $5 million policy. He was ready to give that money to his children because he wanted to see the smile on their faces when he gave them that money, rather than wait until he died until they'd get a $5 million policy. Again, a different attorney refer the client to me just to see if that was the best outcome for his policy. And sure enough, client had never heard of a life settlement where he or she was able to sell their policy. So he accepted a $2.2 million offer So instead of the 1.6, the client got the client got more money than he would have gotten had he surrendered that policy. And in addition, we got him a $250,000 retained death benefit for his family. So instead of the $1.6 million, the client got a significant amount more money and an additional $250,000 death benefit, retained death benefit. Clients in both situations are very happy. I'm not going to spend a lot of time on this, but those of you that are familiar with the Secure Act know that an individual is now no longer able to use his or her normal life expectancy. And instead of having a life expectancy for a 25-year-old of 57 years, he or she now has a withdrawal obligation for a 10-year period. That results in a higher tax, approximately $20,000 higher per million. Do the math. Got a client with a $5 million IRA. Client's going to have an additional $1 million of taxes, income taxes, future tax liability. The use of life insurance for that $1 million additional tax liability is certainly something that a parent can do to cut the tax bite, the future tax bite for his or her child or his or her children. State taxes are going up. You're familiar with the fact that the sunset provisions, where the exemption today is around $12 million, it's going to be reduced to around $6 million in beginning of 2026. State inheritance taxes, basically, of course, started a lower threshold. So the costs to pay estate taxes are going to increase significantly, and they're going to increase for many additional people. A better way to pay those future estate taxes is through a guaranteed universal life policy, because that will maximize the death benefit without the accumulation. An even better way to pay those estate taxes, since they're needed at the death of the second individual, is to be able to buy a second to die policy, because it offers a less expensive way to pay those estate taxes. If you don't need your RMDs, your required minimum distributions from your IRAs or 401s or 403s, a very painless way to pay your estate taxes is to be able to use the RMDs and put them into a life insurance policy to be able to pay for those taxes. If you use the same old way, you're going to just, continue to grow your estate and grow the estate taxes that are going to be due. And as you know, withdrawal from the IRAs, it's going to trigger income taxes, whereas using a second to die policy to hold those RMDs is a much better idea and a much less expensive way to pay those estate taxes. If you go down to the middle of the page, the cost of $500,000 guaranteed to age 96 for a male 78 is $28,000. For female age 74, the individual cost is $18,800, but a second to die for both is $16,700. It's an ideal way to pay for estate taxes. Polling question number 3. And back to you, Jim, or back to you, Sol.
All right, Henry, it's back to you now. Thank you.
Okay, now I'm just wondering, is there anything else that you could do or I could do so that I don't have to restart my program the way that I did the other 2 times?
Nope. On my end, I cannot do anything with
Okay.
your presentation. So you
All
can
right.
try, clicking on the
No,
presentation once again.
No,
or
what I did is
simply-
you know what I did? So I, instead of Xing out, I just moved it down the screen. So let's see if that works.
Sure.
Nope, doesn't work.
You can press escape once to, exit the slideshow and then start the slideshow again.
Okay.
It might
Do that
work.
again. I apologize to the audience, but whenever the polling questions come up, I lose the ability of moving my slides. So give me a second. I've got to stop the share and then I've got to start it again.
So I think that when we launch the polling question, your Zoom gets, on the screen, and it doesn't give you access to your PowerPoint slides. So that might be
Yeah.
the case that you're not able to access it.
Okay, well, let me
That's from the
try
same
to,
line.
okay. So most important questions, we've got another 4 minutes left, so I'm going to try to just move this along. Most important questions to ask your client. Is death benefit sufficient? How long do you want it to last? How long will your coverage last? How much will it cost? And most importantly, how do you know? Where are you getting that information from? Is it accurate? Are you getting the maximum value for your premium dollars? Have you recently shopped price? How do you know? Who's done that for you? Have you seen the results? Are the results accurate? Are the results valid? When was the last time you reviewed your life insurance portfolio? Are all beneficiary designations up to date? So I leave the last 3 minutes for questions. Do we have any questions from the audience? I don't know, Jim, I don't know if there are any questions in the queue, but I'm just leaving the last 2 minutes for any questions.
I'm sorry, Henry, but I think that I assume that you were silent this last minute, previous 1 minute.
No, I left the last now, 1 minute
Mm-hmm.
just for any questions. So if there
Okay.
are no questions, then I'm going to ask myself a question.
Okay, sure. Let's see. We do have one question.
Okay.
It's what age do you recommend for insurance to LDT 120? Sorry, last till 120.
Okay. So there's 2 questions there. One, when do I recommend a person start insurance, and then lasting to 120? I recommend that a person start an insurance portfolio when he or she has either a child, has a mortgage, has someone that they have an obligation to, whether it's a spouse, leaving enough money to pay the mortgage, leaving enough money to provide for family income for that wife and perhaps child, guaranteeing a educational fund so that that child can be taken care of without the spouse having to remarry to replace the income. Biggest favor you could do a spouse is leave them in a comfortable position where they don't have to replace the deceased spouse's income. And with a term policy, if you're dealing with a young child, the cost for $1 million for an individual age 30, guaranteeing $1 million for a 20-year period is going, for a healthy individual, is going to cost about $400 a year. And if $1 million is too much, $200 a year in annual premium will guarantee $500,000 tax-free for a spouse in their early 30s. For anybody with a large estate, I suggest that they begin providing a guaranteed source of income to pay, not income, of a lump sum to pay for any sort of future estate taxes. And that they begin doing so in their 50s, rather than waiting until their 70s, and all of a sudden being faced with a significantly large premium that might dissuade them, or where their health might dissuade them from actually purchasing the coverage. You're much healthier and much younger, and the cost is much less expensive in your 50s. So if one knows that they're going to have an estate tax problem or an estate tax issue, it's not a problem to have several $1 million. But if someone knows that they're going to have an estate tax issue, it would begin making sense for them to purchase that policy that's guaranteed till age 100 in their 50s, or certainly by the time they're 60s. Don't wait until your 70s and 80s, because the cost will be higher and your health may not allow you to do so. I hope that answers the individual's question.
All right, we do not have any other questions from any of our attendees. So I think we are good to wrap up this session. So do you have any
Okay,
last words?
it's been a pleasure. Yeah, last word is there's some handouts that I passed along to Saul, and I believe they should be on the screen somehow. So take a look at them. There are two relevant articles about everything that I just discussed for the last, for the last hour. And feel free to use me as a resource if you have any questions. I think my information is in front of you, or if not, on the handouts. So thank you, Saul. Thank you, Jim, for hosting this, for the invitation, for setting it up. And thank you for your attendees for their hours worth of listening. I hope you got something out of it.
Thank you, Andre. Thank you so much. And thank you so much, everyone, for joining us today for our webinar on MyCPE. I hope you found this information informative and engaging. I'd like to extend a special thank you to our presenter, Henry, for sharing his expertise and insights with us.
Thank you.
And Henry has been one of our best presenters, and we are always thrilled to have him on our platform. So thank you again, Henry, for this wonderful session.
Thank you all.
You're most welcome. One more important thing, everyone, to obtain your credit certificates, you will receive an evaluation form within the next 24 hours after the completion of this webinar, provided you have answered all the polling questions. If you have any further questions or need to view the recording, please feel free to reach us at support@my-cpe.com. Also, we would love to hear your thoughts on today's webinar. And it would be really appreciated if you record a brief video testimonial in the evaluation form to let us know how it did. Once again, thanks so much for being such a wonderful audience. We appreciate your participation and hope you will join us again for future webinars. Take care of yourselves and your loved ones. Stay safe and stay healthy. Have a great day ahead. Thank you, Henry. Have a great day.
Thank you, Saul.